Hi everyone, hope you're having an amazing day. My name is Fumilola and I'll be your host for today. Our topic is compliance demystified, tips for fundraising success, and it's basically targeted at startups to let you know exactly what it is you need to do when it comes to compliance ahead of a fundraising round. The company organizing this, of course, is Curacel. If you don't know who we are, we own Curacel Grow. That's basically a product that helps provide AI powered insurance infrastructure to help startups acquire new users, boost sales, and enhance revenue through embedded insurance products. Thanks so much for joining in. So we'll wait a couple of minutes for other people to come on. But while we wait, I will add my guests for today. We have two guests. We have Pete, who is the COO at Curacel. Hi, Pete. Good afternoon. How are you doing?
Hi, for me. Good afternoon. I'm very well, thank you. How are you too?
Yes, nice to have you here. I'm fine. I'm great. Um, Pete is, of course, the COO at Curacell, and he's a dynamic entrepreneur with a relentless drive to innovate, create, and tackle complex challenges in both emerging and developed markets. As the COO at Curacell, he pioneers it's a pioneering insurtech venture backed by Y Combinator and Google. He leads sales, customer success, marketing, and overall operations, playing a pivotal role in driving the company's growth. With a proven track record in driving revenue and market expansion, Peter's strategic mindset and exceptional leadership skills have propelled Curacell to new heights. His ability to seamlessly integrate sales and customer success efforts ensures a cohesive and customer centric approach that sets Curacell apart in the industry. Thank you so much again for joining on. We also have Ayodeji Olufolahan, who is the senior associate. He's a senior associate at TLP Advisory. Ayo, nice to have you here today.
Hello, can you hear me? Okay, yes, good.
Yes, yes, we can hear you
Nice to
now.
be here. It's a pleasure to be here. It's a
Yes,
pleasure to
nice
be
to
here.
have you here. I'll go ahead with Ayo's bio as well. He's a seasoned transactional lawyer with nearly a decade of experience practicing law in diverse fields, including intellectual property, entertainment, media, technology, and venture law. He has a proven track record of handling complex legal, technological, and business transactions and providing exceptional legal counsel to a broad range of clients, including creatives, both tech and non tech corporations, and angel and institutional investors. He's a senior associate at TLP Advisory, where he provides legal advisory services to technology and non technology companies. He obtained his LLB from the University of Ilorin, BL from the Nigerian Law School, and LLM from the University of Ilorin. He's a member of the Nigerian Bar Association, International Trademark Association, and Intellectual Property Law Association of Nigeria. He has an impressive personal and professional relationship with all his clients, and he enjoys educating his clients on legal matters that pertain to their business whenever he has the opportunity to do so. He enjoys traveling, sharing ideas, researching, and listening to music. So it says here that he enjoys educating his clients on legal matters, which is exactly what he'll be doing for us today. So he'll be going through everything legal that we need to know when it comes to compliance for startups. And of course, Pete will also be providing his perspective as a startup exec. Welcome, guys. Great to have you.
And it's
So,
good to be here.
yes. So, just right off the bat, I think I should start with this question first. When we say compliance generally, what does it mean to you?
When we say
Just from
compliance, it all depends. So is it for me or for Pete?
let's start with you.
Okay, so when we say compliance, basically, right, it's as simple
Mm-hmm.
as being compliant. There are
Mm-hmm.
terms and conditions for startups that they
Mm-hmm.
expect their users to be compliant to be able to for them providing that particular service or selling that product to them.
Yeah.
So there are some laid down rules and regulations by government institution, agencies, and the likes to be able to regulate a particular sector or industry. And
Yeah.
these are to ensure that the industry goes smooth and people are doing business without, looking at
Issues.
their backs, right? So
Yeah.
regulations, compliance. That's it to me. Ensuring that things goes as it's supposed to be go, so that
Yeah.
we'll get the same the result we expect to get. So basically, that's it.
Yes. Yes. Okay. Thank you so much. Pete, on your own end, so when you say compliance in terms of investors or whoever is looking for startups, what does this mean to you?
Right. So I'd like to see compliance. I mean, in the way Ayo has also described it, but maybe a bit slightly as well. So imagine this a society where there are no rules, you know, everybody will just start doing what they want. You're going on the road and there's no demarcation on where to drive and where not to drive. Already in Lagos right now, there's demarcation, but people still drive one way. So now imagine that there are no rules. So yeah, so that's why I say compliance. So a set of rules that must be followed to just maintain law and order. Um,
Yeah.
and definitely in the startup ecosystem and as related to funding and investors, the way it is just investors have like a set of things that they look at, that startups then have to be compliant with.
Yeah.
So even give the investors like um, a bit of rest of mind to say that we are doing what we should do in regards
Yeah.
to all the rules that have been laid down for us.
Yeah. Okay. Thank you so much. So we'll go into our first question. This is, what are the key risks that investors typically assess when considering investments in a startup? And let's start from there. So, key risks that investors typically assess, and then we'll go on to how can founders effectively manage and mitigate these risks. So, I think we should start with you here.
why me?
Okay,
So
next one, we'll start with you.
okay, no, the reason why I'm saying why me is okay. So
Okay.
Pete is in the industry basically when it comes to all these things, so he understands majorly most of these risks. But my experience is based on what investors basically point out, especially during our legal due diligence. Remember, I'm a lawyer, right? So what we DD is not the tech side. We basically DD the legal, right? Try to ensure that they are in compliance with certain laws and the rest like that. So based on my experience, right? I'm not saying that's a textbook rule. But based on my experience and what I've seen, what I see that investors basically look out for, they look for market risks. So they want to be able to ensure that they're trying as much as possible to assess your market potential. They want to be able to see who are the competitors in the industry. They want to be able to see are customers or are users really demanding this product or services. So and those are the things that investors basically look at. Like they look at markets. And to answer the second phase of the question is that to mitigate it is by founders ensuring that they conduct thorough research, market research, as it relates to that particular industry, so that they will be able to, you know, show the investors that they know what they are doing and they understand their target audience, basically, right? And
Yeah.
also show the investors that they have like a scalable business model. So that's that for market risks that I know that investors basically looking for. And they also look out for execution risks. It's simple. Execution, okay, I wanted to mention a VC firm. So I had a conversation with one of the a general partner in one of the top VC firms, right? And one thing that he looks out for is execution. He wants to know if this set of founders are people that talk and do, you know that kind of thing. So there are a lot of ideas. A lot of ideas is flying. You can just sleep one day and wake up and you have ideas, but does not mean you can execute that idea. So you can just come up with different business model, no execution plan without being an executor. That's the point. So they want to be able to see, okay, do you have the right set of team that would execute this? Are you an executor? What are their experiences? What are the things they've seen in the past that would make them feel like, oh, is this person, especially founders that have maybe you've you've started a business that has failed like 2 to 3 times or 4 times, and you're starting like
Mm.
your fifth as a serial entrepreneur that you are. You're starting like a fifth business. So founders and investors will basically look back and see that, okay, what is your business plan you couldn't execute? Why will you be what will
That's
give us that
just,
confidence that you're going to execute this one? So they look at
mm-hmm.
financial risks also. So they want to be able to scrutinize the health of your startup financial health. They want to be able to know your revenue projections, the burn rates, the runway. A lot of founders don't think that investors. There was a new client, a VC firm that we just brought on board in our law firm, that I learned certain things from when it comes to runway and burn rates. I'm a lawyer. I'm very bad with maths. I really don't like maths, but because of him and the fact that he involved us in a negotiation when it comes to all these things, which is not part of
Mm-hmm.
what we're employed for anyway. So I noticed that the investors, because of the way startup founders do now, they collect fund. Immediately they collect fund, they go and buy G wagon. Their office is everything is smart. Alexis, can you get me a coffee? Everything money that they're meant to use to scale business, right? They just need to just spend to make the office look good just for the paparazzi because they believe that they own no investors. It's not a debt, especially when it's not debt, when it's like a direct equity, right? So what investors now look out for, they want to see be able to access the financial risks. They want to know your runway. Runway in the sense that they want to know uh, how many months can you survive without when you now start needing money, that you run out of money, you run out of funds. That's your runway. They want you to see that and look at your burn rates. How much, that kind of thing. Assets both
Yeah.
together to be able to see if you are like your financial, what's the word called? Like you are balanced, right?
Yeah.
And as a founder, one way to mitigate this is to ensure that you show to your investors that you have strategy in place for unexpected financial challenges, right? Basically,
Yeah.
and you have a stricto sense. So I know burn rate can change over time, but when you agree, it is best you agree a burn rate with your investors. That will make it will give them that settlement that, okay, this is how much the amount these guys will be spending within a certain period of time, and this is how they're going to be using the capital. So that'll give them that. And when they see your runway, like this runway matter has allowed a startup not to get, I think, $800,000 just because their wrong way. They told the investor that, okay, for before they will need money, they need like they need like now, like I think $900,000 to still afloat for a duration of time. And the investor wanted to invest, I think, 500. And the investor now said, you know what, give us confidence by showing us evidence that you've raised the remaining. Since this is the money you need to stay afloat for a duration of time before you start making profit. So, because imagine if an investor gives you 500K and you need like 900 to stay afloat for a duration of time, it means that you spend the investor's money and nothing will come back to the investor, right? So
Yeah.
investor will be able to access that financial risk to be able to determine if
Yeah.
they are
Yeah.
going or not. Technology risks, I
Yeah.
think Pete will speak more on the technology
Yes.
risks. They want to be able to know if your technology is,
Mm-hmm.
scalable, that kind of thing. I'm not a tech DD guy, but I've seen some of my tech DD guys, what they look out for basically is the reliability and the scalability of that particular technology. Can it adapt to advancements? These are the things that the investors really want to take note of. And my
Yeah.
own part, which is the regulatory and compliance risks. Investors want to be able to ensure that you are in compliance with certain laws, especially in the industry you're playing at, especially
Mm-hmm.
those startups in fintech, in that kind of thing, initial tech and the rest like
Yeah.
that. Investors want
Mm-hmm.
to ensure that you are in compliance. That is one
Yeah.
major thing. And one of the way to mitigate this particular risk is to ensure that you have a lawyer at your back end that can help
Yes.
you through this journey and the rest like that, that kind of thing. And
Yes.
investor also want to be able to one risk that I know that investor basically assess. I think two investors, especially VC firms that I've worked with, is the IP risk. So a lot of startups are IP driven. A whole lot of them are IP driven. Investors know that if the IP goes south, the business goes south too. So they want to be able to ensure, so they want to have this assessment that the IP is housed by an entity they're investing in. I cannot be investing in Pits and the IP of Pits is housed in Lola. What's the connection between Lola and Pete? I need to understand that. So I understand that my investment is safe because I'm investing basically on the IP. If the IP goes, the business goes out. So one way founders need to mitigate this is to ensure that they have that plan, IP strategy. They've registered what needs registration. They've protected what needs protection. And last, so that Pete will go and say the remaining. Is the reason why I wanted to say this, right? Is a lot of startups don't take into cognizance testing exit strategy risks. There's a difference between VC funding and private equity. Startup founders should understand that. It's a two-way. Private equity, they want to buy your company. They will kick you out at longer run. That's their end result, right? they will kick you out at the longer run. That's their end result. They don't care. Their own is we buy in, we buy you out. That's the plan. But VC funders, the other one is we invest in, and do you understand that kind of thing? We get back our
Yeah.
returns at a particular duration of time, maybe 7 years. A lot of them have plans. Some VC fund and VC firms, they are like 7 years plan for exit. Some, that kind of thing. They have several different plans. So one thing they try to assess is what is the exit strategy risk in this particular business, because we want to come in and go with maybe
Yeah.
1x, 2x. So we're able to give returns back to our other investors in the VC firms, that kind of thing. So as a startup founder or startup, one way to mitigate this risk is to ensure that you yourself you have an IP strategy. You as this IP strategy, you have like an exit plan for your
Mm-hmm.
investors. And
Yeah.
the exit plan is in cognizance or is in agreement with their own strategy also. So you know your investors, you know what they want. I'll give an example of a startup that when the VC firm we're representing and the angel investors were representing wanted to invest in this startup. The startup plan, the startups already informed, founders already informed the investors that they are going to be acquired in the next 4 years. So now the investors already know that our exit plan is the next 4 years. After acquisition, we get back our money with certain amounts since we're preference shareholders, right? So we get like 2x, 1x, depending on whatever thing that was negotiated. So now, because of an international organization is already acquired, it makes the investor increase the investor confidence in investing because now there's a fixed strategy on ground that is in play. So these are the things that I believe that the risks that I believe that investors basically assess and how founders
Yeah.
can mitigate that risk. I hope I have
Yes,
spoke.
you have. Yes, you have. Thank you
All
so
right.
much.
All right.
Pete, I think Ayodeji has covered a lot on this question. Do you have anything to
Yeah,
add
I was gonna
to?
say that Ayo is not did not want to go first because he then had like 10 minutes to dive into what he wanted to say. But anyways, yeah. So I think one of the ones they mentioned, the I think you called it founder risk. They also call it team risk, where the investor wants to know if they are investing in people who already have experience or who have the expertise or who have the training. So, for instance, investors will typically ask if that's your domain. So, for instance, if I'm launching like an healthcare startup and I'm a doctor, I increase the confidence of the investor to invest in the space, right? Um, or if you're a second time or third time founder, you have exited a startup. In fact, people that have exited a startup, maybe they have had like a successful exit, do not need to really pitch a lot to investors. They can just cite your story. Oh, I founded that other startup, exited for like 100 million. Now I need money to run this other startup. Like they're just gonna give you that money instantly. Um,
Yeah.
but for like maybe very early stage people, one of the ways to also pull this off is to get experience in working with a startup, getting all the deep deep dive into like all the experience that is needed into coming into your own as a person as well.
Okay. Okay.
I'll
Thanks
come
so
back to
much.
Nigeria. Sorry for me that we are spending so much
Okay.
time on this question.
No problem. It's
I'll come
fair.
to Nigeria. I mentioned something that looks like financial risk, but I call it currency risk. I think a couple of people also call it that. Where as a company, maybe you take dollar investments, but then you operate. Nigeria is your primary market, which means you earn in naira. So let's say you took the investment of 200K last year, where dollar to naira was 500 naira exchange rate, um, and then you earn your revenue in naira as well. Suddenly, 2023 comes, and then the dollar to naira is 1,000, which means your revenue is essentially slashed in half. What you then need to do is to start like, okay, the mitigating way to look at it is to start looking out of Nigeria, looking into other markets, where you can also earn better stable currencies, or even look into European American markets where you can also earn in dollars. So that's one way to mitigate that type of risk. I'll stop here because of our time, but I have a question for Ayo, and I hope you answer this later. There's something called key man risk, which is where maybe one of the top guys, maybe the founder, um, is. I'm sure you know key man risk, so I'll just let you explain and see. Do investors also consider this as one of the risk?
Yeah, okay. So to answer your question quickly because of time. So key man risk is peculiar to a particular business. So when you're talking about key man risk, you're looking at a business that basically relies on one person. So when the business relies on a particular player, meaning if anything happens to that particular player, the business goes downward, right? So those are kind of risks that investor basically look at. So when investor knows that they cannot mitigate or there is no alternative to that key man, so what they basically do is they find another means, either maybe by insuring the key man to ensure their security is protected. So that's one way investor basically ensure that maybe they have that as a condition subsequent of the investment. So we will invest though, but after our investment, ensure that so individuals are insured, so that we know that okay, we are protected in case if they fall sick or they die. Anything can happen, especially when you're in Nigeria anyway. So that's to answer that.
Okay, okay, thanks so much, Pete, for that question. So now basically we know key man insurance or getting key man insurance is one of the ways where you can basically prove to investors that you've considered protection for your main person when you have like a main person in the company, etc. Yeah, so we can move on to the second question here. The second question is, in the context of fundraising, what are some common regulatory compliance challenges that startups should be aware of, and how can they navigate these challenges? So, Pete, we'll start with you. Um, what are some challenges, compliance challenges that startups should be aware of, and how can they navigate
Yeah,
them?
I really feel like this is where Ayo should start, but then I'll go.
No, don't
Okay.
worry. I can help.
um,
I can go if you want me to.
yeah. So I just have a few comments first before you go. If we bring this thing back home to like our climate, Nigeria, maybe some part of Africa, I feel like most of the biggest challenges that startups will face would be one, the fact that there's no real clarity around what the exact compliance that they're supposed to follow are. Um, so that would be my number one. My number two will be funding as well. So, for instance, a company that's maybe is a fintech startup, what that means for them is that they have to get some very expensive licenses, say from CBN. But these are just two people just starting this startup. They really don't have the funds, so now they cannot actually execute that idea because of that. So that's number two for me. I think the last one would then be again bringing it back home to Nigeria would be how straightforward and seamless the process of applying for some of these things are. You find out that if, for instance, you need to go to CBN and then follow some certain kind of procedure for 6 months, you even get tired of the founder, like, okay, why am I following all those things before I get this compliance certificates and all of that? So these three are like, top three that come to my mind. And when I think of challenges that founders will face, I'll leave the rest for you.
Okay. Mm. So I'll just mention a few of them that I've experienced, especially in my years of practice. One of the challenges is security regulations. Basically, securities is, as a founder, either your investment is either in safe, that's the YC standard safe feature equity, keys, that's for Techstar, similar to safe, or direct equity or convertible debt, depending on the kind of security you'll be offering your investors. One challenge is to ensure that all of them different they are regulated by different security regulations, right? All. So one challenge is to understand that for you that you are issuing safe, you're especially when the safe is with a foreign entity. I've seen when we try as much as possible to tailor safe to the Nigerian space and regulations and the rest like that. Understand that when it comes to securities are highly regulated. Even your shares that you are issuing now, corporate affairs commissions, as the commission as per corporate, they also have a way of ensuring that okay, if you are issuing shares, you need to do this, you need to do that, you need to do this, that kind of a process. So that's one challenge is understanding the kind of securities you are offering. To navigate that is to ensure that you're working with either a lawyer that would put you through, that will help you with negotiation, and you're also aware of the applicable security laws that are regulating these securities that you're offering during your fundraising period. And one other one, this my like I have said this. I think I can't remember where I went to speak, and I said this, and it felt like maybe I was shooting some founders in their legs. So one thing is founders when you're looking for money, it's just the money that is your business. And every other thing is not your business. So founders don't understand that there is a big challenge as it relates to AML and KYC regulations. It's anti-money laundering. A lot of this, especially when it's an angel investor, a lot of them might be money launderers, and they might be blacklisted, right, in some jurisdiction. And you're right there putting them on your cap table. You didn't do necessary AML or KYC. I know it's a challenge for you to, one way to navigate is ensure that you collect necessary documentations to be able to identify these investors, especially angel investors. And there are platforms and service providers that do this, helping you to check if that particular individual has been blacklisted in any of the jurisdiction, because it's a big deal. The moment maybe you are trying to work your maybe acquisition and the rest like that, and they check your cap table and they are seeing a blacklisted individual there, a money launderer, someone that funds terrorism and the rest like that. That is, they will believe that it's an obligation to you for you to do KYC and AML. So that's one challenge that I know that some founders are like, then when you ask investors for too many questions, no, do your own DD. Investors are doing DD on you. You also have the right to do DD on them. So that's one way to basically mitigate that. Know your investors, basically, right? And another challenge is what's the thin line between soliciting and advertising for, most startups in Nigeria are private limited liability company. Private limited liability companies are restricted from advertising or soliciting for investment without proper regulation. You cannot publicly advertise your sales of your shares. Understand, that's the bitter truth. So the challenge is now for you to find the thin line in saying that, okay, oh, you are not advertising or soliciting for investment or publicly selling your shares, so ensure that the conversation for fundraising is within the private channel, not public channel, and be careful of the kind
Yeah.
of statement that you are making in public, right? Basically, be careful of the kind of statement you're making in public as to your fundraise. Maybe after fundraise, you can just say, oh, successful fundraise, blah, 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 depending on the kind of security that you're going to be offering. So that's one challenge I know that, what's the word called? Status and the rest. And one, I just want to mention this because this is like a trend. So we now have platforms and service providers that provide like a platform that startups will come and do fundraise, right? So one thing people should understand is that is crowdfunding. So service providers like that or platforms like that will tell you as a startup founder, come, right? Will help you raise funds. I will raise your fund, do your fundraising by collection and whatever from our own network. That is SEC. It's I think when crowdfunding started, SEC they didn't dive into that process. But the moment they see that a lot of people are now diverting into that process to hide under fundraise and the rest like that, SEC decided to do what? Regulate that affairs. So if as a startup founder, I know it's challenging when you just want to raise and these people are helping you, ensure that whoever is helping you, whatever platform that is helping you crowd fund for your fundraise is a licensed platform. And also ensure that you are in compliance with what SEC says for those startups using those kind of platform. It's very, 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 very important. And last but not the least, is the I think contractual compliance basically. That's one challenge. A lot of founders when they want to start raising fund, they only care about the money. They can give it, investors will ask for this, ask for that, ask for this, ask for that, they'll be giving it. So sign agreement, they don't even know the implication of the rights they've given those investors. They sign. So now after investment has been they've received money and everything, now fulfill obligations based on the right that you're giving investors. Now they are doing like, no, this is an unfair deal, this is unfair deal, this whatever. One challenge I've seen that several times. Before unfair deal, when before you collect the money, negotiate. And not just negotiate, when you've negotiated these terms, ensure that you put in place process to fulfill this obligation. You don't just negotiate term without process in place. So that's let me talk too much. That's
Yeah.
before I thought
Thanks
this is
so
TEDx.
much.
So that's it.
Thanks so much, Ayo. Thanks so
Yeah.
much. So, another question that we have here is, yeah, so this is more for Ayodeji. Could you please provide examples of how risk assessment and compliance have influenced investment decisions in the startup space? So,
Okay.
the examples that you know from your own
Okay.
experience. Please
A
don't make
lot.
any mistake and mention names.
No, I'm not mentioning it, but it's a lot. So it's a lot.
No
So
problem.
we've spoken about risks, right? What risk assessment, what investors did look at. So you already understand that, and compliance basically,
Yeah.
right? So one example, like I have like three examples that I would like to share because these are different risk assessment and compliance issues, right? So
Mm-hmm.
investor basically look at regulatory compliance basically, right? So there was this VC firm that our client, I wanted to invest in this portfolio company, right? It's a fintech company, and solid. When I say solid, solid, the product and services, everything is it's going to be like it was good planned, good whatever. So during our DD, we do Lego DD and we also do Tech DD. That the investor basically handles the Tech DD part. So during our DD, we discovered that, and the investor, the general partner of the VC firm, is an experienced person in financial industry. So he understands that there's this particular startup needs license, or either needs to collaborate with the license entity by leveraging on that license entity's license to carry out that particular service or sell that product. So during DD and conversation, we found out that these people are not even aware of the necessary regulations that they need to comply with. They're not even aware that they need license. They were so just about the technical product and what the product can do that they are not even, and their team, no member of their team is even experienced enough to understand this whole process. They don't have a lawyer, there's a whole lot. And because of this lack of compliance and also lack of knowledge of the required compliance, or even the backdoor like collaboration, they don't have idea about those things. The
Mm-hmm.
investor opted out from this particular investment. Not like these guys don't have a good product or technology product, no, good idea, good solution to certain problems. But because of this, the investor opted out. Just because of regulatory compliance. It would have been different if these people even have an idea. And in the conversation with the investor, they are like, we'll get the license after this fundraise. So the investor basically understand that, okay, we'll make this a condition subsequent after this investment and ensure that this is done. So one. So second one is IP, intellectual property protection. So basically, investors, especially for startups that are IP driven, so long you know that everything about your business is IP driven, understand that investors will be peculiar about the protection, like the IP, which entity is housing the IP, is the IP properly protected, and all this kind of thing. So the example I want to give you was angel investors. Set of angel investors came together like syndicate to want to invest in a startup that is energy industry, so like an energy tech, right? And that energy is innovative ideas, innovative whatever, and all that kind of thing. So because of the kind of innovations these guys have, the investors need to be sure that those innovations are protected, because those innovations are not protected, the business might not even float, because if everybody's just producing it, the reason why people register their patent is so that they can be able to exploit that particular innovation for a long time in the market, maximize commercial exploitation of that particular work, so that investors see that innovation as the reason why they are investing. But these guys, when we did the DD, we found out that these guys already have all these things in place. They've patented in the UK, they've patented in Nigeria, that kind of thing. So in
Yeah.
throughout the market, even when they are not ticking the other boxes like financial thinking, everything is just a little bit messed up and the rest like that. The investors were ready to invest because they know that, okay, at least the IP asset is protected. In case if anything happens to the business, we can sell the assets and recover back any fund, right? So
Yeah.
that was one way why one thing that necessitated, that gave confidence to those investors to invest. And the last example I'll give is in the arena of privacy, data protection basically. So there's this VC firm that wanted to invest in an health tech. And health tech, because of the kind of data they collect and process, a lot of sensitive data, right? So one thing, the first DD the investor told us to DD was to ensure that these guys have the proper data protection policies in place. The employees are aware of these policies. They have no other kind of thing, and they have proper security as to securing personal data of their end users or their customers or their client and that kind of thing. And we did that. We did that DD, and we came up with our recommendation that all these things were in place, and these people they were they were aware of the sensitivity of the fact that them not having all these things in place can destroy the business as a whole, and can even have like a financial implication on the business. These guys have these things, and the investor, before we even did the Lego DD, the investor already gave them an offer. So it was after offer we have now
Mm,
even deciding on, okay, let's do legal DD, let's see if the entity has been properly registered. So these are the things
yeah.
that these are the examples that I can give as it relates to how um, this affects investors' judgment and stability in
So,
investment.
from the examples that you gave, IP protection, regulatory compliance, and data protection as well.
Yes.
Data due diligence. Okay. Thanks so much.
Yeah,
Please,
yeah.
do you
I
have
was
any
going to
comments?
ask.
Okay, your
No,
questions.
Y- Yeah. I was going to ask Ayo to, because we have like a diverse audience here. You say DD every day at work. So, but explain DD to people.
Oh,
What does
Didi.
DD mean?
Sorry. DD is due diligence. So if any investor wants to invest in a startup, they first of all do a due diligence. Due diligence, we have like a checklist that as lawyers that we send to this portfolio company. You fill in the gap, you give us necessary information. We go through all this your data. Then we look for the ones that are not connecting. We advise on that, recommend. And you as a startup, when you're doing DD on your investor, what who the investor is, identify the kind of investor you're investing in, even find out where the startups that have invested in and what is their relationship with those startup founders, that kind of thing. And also most especially if you can find out the source of their source of wealth, basically. So that's due diligence, basically. That's what we mean by DD.
Okay. Okay, so I'm going to try to breeze through the rest of the questions. We don't really have much time. Um, okay, so I think this is important. What are the primary financial and operational metrics that investors look for when evaluating a startup's readiness for funding? I think in a way we've discussed this, but
Yeah, I
does
think
anyone want to
Ayo.
give a brief summary?
Yeah, yeah. Yes, I'll do a brief summary. I think I also mentioned a bit of it in the beginning. So typically, your investor wants to know what's your growth rate. It's maybe like one of the most important metrics that they want to see. So week on week, how are you growing? Again, this might be different for different kind of businesses. So B2B businesses might not sign customers every week. But let's say a B2C business, what's your week on week growth? I mentioned in the beginning, what's your monthly burn? So burn is how much expenses do you have every month, essentially. Um, then there is the how much revenue are you making as well, month to month? How much is your revenue? What's your if it's a B2B startup? What's your annual recurring revenue (ARR)? What's your gross margin? What's your cost of acquiring customers, which they call CAC? Um, what's the lifetime value for the customers that you have, that they call LTV? What's your runway? I mentioned this in the beginning. So if you have 200,000 and you're spending, or 240,000, you're spending 20,000 every month, that means you have 12 months, so 12 months runway to finish spending that money. So these are some of the things that, investors always ask for. On the other side, operational, they want to see what's your retention rate. How many users do you have? Um, how are those users churning? What's your churn rates? Um, what's your engagement metrics with them? How are they engaging with your products? Again, this might be different for different businesses. So for B2B, it can just be something like how many contracts have you signed up, or how many major partnerships do you have? For B2C companies, it can be something like how many people do you have on your wait list, something like that. So there are different things that they look at. I'm sure for people who are really, really interested in also like starting up or already have startups, they know their numbers already. They know what investors would typically want to see when they share these things with them. So I think in brief, these are like maybe the most important metrics
Yeah.
operationally and financially.
Yeah, thanks so much. I think that covers it. I think that's basically it, right? I
Yeah,
think
that
we've
that's it.
touched on
That's it.
everything.
That's it basically, right? And that's not my
Yeah.
expertise. But one thing I would just mention is if you're giving investor number, don't fake the number. A lot of startup founders are now fond of buying numbers now. It's criminal. So the moment whatever thing you tell me, it's a warranty. Basically, all these things you're telling me during our DD, during our conversation, in the investment document, we ensure that we put it as all these are representation. And if those representations are totally wrong, there are something I will call claim that will put it that we a investor can decide to lay claim based on wrong representation. So don't go and buy numbers or fake numbers. So that's just
Yeah. Okay. Thank you so much. I'll skip the intellectual property one because I think we discussed a bit about that. Data security and privacy compliance. Okay, so um, the first part of this question is how important is data security and privacy compliance, but we've touched on how important it is already. So I think the second part of the question is what measures should startup founders put in place to address these concerns? Is this a Pete question?
Okay,
Or
let me just quickly mention let me just quickly state like few what's the word, like few
tips?
let me just few tips basically, right? So
Mm-hmm.
data protection is not just uh, it's an legal obligation for all businesses, right? Legal obligation. Depending on where your customers are, you need to comply with that regulation. So we have like GDPR, we have GDPR, we have NDPA. Let's just stick to Nigeria, the Nigerian Data Protection Act, right? That just recently been recent law basically states that it's a legal obligation as a business owner that you are collecting and processing data. You need to you need to comply with this obligation. And one way for you to address one measure to address data security and privacy concerns is one. I've seen this happen several times, especially when I talk with startup founders, is that they fail to even have like a process to identify sensitive data. So they don't do this what's the word called categorization. They don't categorize data. So when you categorize data, it means that your gate man should not have access to certain information of your customers.
Yeah.
Your secretary should not. No, when you categorize data, it then spread along the rows of your staff. So your staffs, there's some staff that have access to these, there's some staff that has access to that. So my dad owns a microfinance bank, and there's a way we do the portal. It's not every staff that has access to certain things. So there's a way we block it. That is how you categorize certain information, certain sensitive data. You categorize them. One is don't collect data that you don't need. Imagine a fintech asking for genotype, blood group. You do you understand my point? So try as much as possible to restrict your collection to the datas that you basically need, because there's no need for you just getting data that you don't need or you're not using. Do you understand that kind of thing? And Pete should speak on these security measures. All those technical stuff, protocols, and I'm not good. I've not learned. I'm trying to learn software development and justice. So put in place security measures, right? And other things, right? And one that I would like to mention, because that's my own line, is ensure that you conduct data audits. So in Nigeria, according to NDPA, NDPA is Nigerian Data Protection Act, as a business that you start processing or collecting more than 1,000 customers information, like 1,000 customer, you are required by law to submit your data audits, to do a data audit and submit it. And DPCOs will help you. That's data protection, licensed DPCO basically would help with that, your data audits report. So you need to ensure that you do that reporting. It's by law for you to do. You're required by law to do when you're processing more than 1k customers information. You are required to do that. That is
Yeah.
something you do. And even the DPCA also provided that data protection act, sorry, Nigerian Data Protection Act also provided that you need to do trainings for your staffs. You need to educate them on the necessary privacy policy you put in place. I'm speaking with the intention that everybody knows that they should have privacy policy on their website. They should have necessary data protection policy document in-house internally. So I'm speaking on that. The data protection document would have your data retention policies and all those things like that. That kind of thing. So based on what the Data Protection Act basically stipulates is that train your employees on the policies you have. Also train them on how to handle sensitive data and personal information of your customers. Last but not the least is appoint a a DPO. DPO is data protection officer. Data protection officer will help you with all this, when there's need for audits. Basically handles your compliance with the NDPA, right? So a data protection officer, you need to, I think it's 10,000. When you start processing more than 10,000, it is required for you to have a data protection officer as a role in your office. So I think that's all from my
Yeah.
end.
Yes, yes. Thank you so much. So, in the process of touching that, we've kind of touched on question seven. So, I'll just go on to the last question because of time. So, are there any scenarios where insurance plays a role in compliance? Maybe I shouldn't say compliance, but I think compliance, fundraising, both, either or.
Yeah,
Okay, is it for me
I
or
think
for
I'll go
Pete?
first.
All right, Pete.
Yeah, I'll
Okay.
go first. So I think the first part is just what we touched on earlier, the key man risk that Ayo talked about a bit. I
Yeah.
think when I think about it, the only the second part that comes to mind is then, let's say startup deals in like hardware. Um, for instance, you deploy POS, 10,000 POS across the country. Um, it will make sense for an investor to know that you have it's giving you money, but you have also insured those gadgets, because you cannot deploy hardware around and not insure it. It means that if
Yeah.
they spoil or they get lost, you are losing the money, you are losing the business, the investor is also losing his money. So it's common sense that, when you deploy hardware, you also insure that as well. Um, and then generally it's just, by Nigerian law, you also need to do like your what we call HMO here, health insurance for your staff. Like those are the generic ones, but it's also mandated once you have more than 4 staff. There's also life insurance as well once you have more than a number of staff. So these are the ones that come to mind when I think about compliance to insurance for startups. AY, I don't know if you have.
Yeah, so the only thing I want to add is that, and depending on the industry that a startup is playing at, there are some industry regulations that state required insurance for certain set of people, right? So that's depending on the kind of industry you're playing in. And if you're playing in an insurance industry, you obviously know that for you to even get the license, there's a need for insurance at certain, all those direct indemnification and all those process like that. So that's it.
Yes. Okay. Okay. That's basically all we have time for now. I think we're over time by about 3 minutes. Okay, so thank you so much, guys. Really appreciate you coming on. Thanks to Ayo and thanks to
I think there
P.
should be a part two. Ayo has so much to dish out.
Part two in the near future,
Yeah, we
hopefully.
should do a part two
Okay,
soon.
thanks so much, guys. Thanks to
Okay.
everyone for joining in today. We'll be including the LinkedIn handles. After this, we'll include our guest LinkedIn handles in the comments. So if you guys have any questions for them or you just want to reach out, you can do that. And of course, if you have any questions on any of the topics that we discussed today regarding insurance, or you are interested in ticking all the boxes when it comes to insurance for your startup, please don't hesitate to reach out to any member of the Curacel team or marketing at curacel.ai. All this information will be included in the comments after this session. So thanks so much again, guys. See you soon. Okay, goodbye.
Bye.
Bye.
Bye, everyone.